Hello and welcome. Thank you for joining me today in my webinar entitled Solving the Inherited IRA Tax Beatdown. This is an add-on to my dinner seminar entitled Don't Let Uncle Sam Kill Your 401k and Your IRA. Welcome. Today we're going to talk about how to save on taxes, in particular for those that have large retirement accounts. So who could benefit from this webinar? Well, the first question I would ask is, do you have a lot of money in 401ks and IRAs? If you do, you're in the right place. So if you have $1 million, $2 million, $3 million set aside in a qualified retirement account, you want to listen carefully because I'm going to show you how to save money for your family. Number two, you won't need to live off of the RMDs. So those required minimum distributions you have to take starting at age 73, if you actually just end up saving those year after year and letting them compound someplace else, and you don't really need to live off of them, you want to listen carefully because today's program is going to show you how to give more money to your family. And the last question I have for you is, do you love your children and your grandchildren more than Uncle Sam? Folks, you're in the right place if you can answer yes, yes, and yes to those three questions. Now, if you haven't already, I would suggest you get a piece of paper and a pencil because I'm going to go through this information very quickly, and I'd love for you to take down some notes. But first, let me introduce myself again. My name is Rick Miller. I'm the president and founder of CSI Wealth Management in Arcadia, California. Now, for the disclosures. Because of my licenses, I have a disclosure. I am not a CPA and I'm not a tax attorney. However, today's topics are going to talk a lot about taxes and a lot about estate planning. And I'm going to share with you some strategies and tips that I've been showing people for a number of years. So grab that piece of paper and pencil and come join me for a great webinar. Let's begin. Solving the Inherited IRA Tax Beatdown. Today we're going to talk about what are called regular IRAs, and this would include money that you're storing in a 401k, a 403b, a 457, or similar type of pre-tax tax-deferred account. We're going to talk about inherited IRAs, and we're going to talk about Roth IRAs. And I'm going to give you an example about the Flintstones family. And we're going to talk in particular about how they can transfer the most amount of money to their kids by using what's called a Roth IRA strategy. We're going to talk about how an inherited IRA would work in their family. And then I'm going to show you how a Roth IRA could help even transfer more money at their passing than using an inherited strategy can do. All right. So before we really begin, I've got to ask you this question. And you've got to believe that taxes will go up. Because if you don't believe taxes go up, you don't need to listen to this presentation. Let me ask that question. Folks, where do you think taxes will be in the future? And I'm talking in the distant future, not the next 4 years of Trump's presidency, not the next 8 years, but over your life expectancy of 20, 30 years, say 15 years plus. How do you think taxes are going to be moving? Will they go down? Will they stay the same? Or will they go up? I believe they're going to go up. And in my seminar entitled, Don't Let Uncle Sam Kill Your 401k and IRA, I spend a lot of time on 4 major factors as to why I believe taxes have got nowhere to go but up. Let's talk about them briefly now and set the stage. Number one, if you take a look at the marginal tax brackets that we've had in the United States, beginning in 1913, because that was the year that Congress passed our first initiation of the 1040, the federal income tax returns that we had to start doing in America, all the way to now, 2025. These red lines on this slide show you the highest marginal bracket in each respective year. And you'll notice in the far right, highlighted in yellow, is the number 37. That means the highest marginal bracket today is 37%. On the very last dollar that you earn and file a tax return, you're going to forfeit 37 cents of that dollar to the federal government. But there were periods of time, long periods of time in our past, where the taxes were substantially higher than they are today. I've circled 94%, 91%, 70%. And if you were to average that over this 100-year period, it averages about 56%. So folks, for a long period of our recent past, we've been way below that average. I think we've been spoiled. Fiscally speaking, let me show you some of the reasons why I believe taxes have got nowhere to go but up. Let's start with the national debt. The national debt is over $36 trillion. It's out of control. We've got to get this beast tamed. And how are we going to do it? Well, I believe that taxes will be one of the ways that our political legislators will go ahead and tackle this problem. What about Social Security? Social Security, 67 people receive retirement Social Security benefits. We're an aging society. Right now, the projected date for Social Security not to be able to pay $1 of promised benefits is as close as 2033. So if we don't do anything between now and 2033, if you were getting $1 in Social Security payments as a retiree, it's going to drop to 75 cents. And then there's Medicare, similar situation. That's not funded properly. That's going to have to make some drastic changes by 2036. And then we've got large pension plans throughout the United States. Here's the CalPERS pension plan. As of last year's report, even though the investment portfolio made 9+% rates of returns, which of course were quite good, it's only funded to 75% of its promised benefits to retirees. So folks, for these 4 reasons and many, many more, I think we're fiscally in a mess. And so that's why I believe that taxes will go up. Now, I'll be the first to tell you, my crystal ball is just as hazy as everybody else's. But if I were to bet over the next 15 years, I believe federal income taxes will, drum roll please, increase substantially. And of course, this is purely my opinion because no one knows what the future will hold. But as a betting man, in terms of where I'm putting my dollars, we are not saving money in qualified retirement accounts. Why? Because I believe that that's just shooting yourself in the foot. So let's go into some details here. And before we do, I just want to warn you, I think taxes are going to go up, and don't let Uncle Sam kill your 401k and your IRA. Now, many of you have seen this slide before, but it never hurts to go through it a second time. There's basically 3 buckets of money that you can set aside to accumulate and build your net worth. The first bucket's called the after-tax money. Then there's the middle bucket, the before-tax deferred money. And finally, there's the after-tax tax-free money. Let's start with the after-tax taxable money to the left. So look at the blue bucket. The blue bucket means after you've saved money from your paycheck or your business and you've paid all your bills, you could store it in an account where that account is titled in your own name, you and a spouse jointly, or your revocable trust. It picks up no special tax benefits in and of itself. You can place the money in this account in bank and credit union accounts like certificates of deposits, CDs, to make 5% interest, or a money market account by the bank that's more liquid, maybe pays 4.2. Or you could buy stocks for appreciation of dividends, or you could buy bonds for the dividends, or you could package your investments in mutual funds. But in all of these cases, you're generating a 1099 every year. You're getting a 1099 for interest, dividends, and capital gains. And you'll have to put those earnings on your tax return. They're not growing tax deferred. The good news, however, is you have no RMDs. There's no required minimum distribution. This is not a retirement account. Now, many of you have the bulk of your net worth outside of your personal real estate, your home, in the middle bucket, the tax before tax deferred accounts. What am I talking about here? Well, you know them by the names: 401k, IRA, 403b, 457. Now, you can invest in CDs in all these accounts. You can invest in money markets. You can pick individual stocks. You can pick individual bonds. You could get mutual funds, and so on and so forth. But the money that's in these buckets is growing tax deferred until such time as you're forced to pull it out. So at 73, you've got to square up with the IRS and start to make withdrawals called the required minimum distribution. And finally, you can funnel money into the third bucket. This is after-tax money. It's typically called a Roth IRA. Today, many companies offer a Roth 401k or a Roth 403b. They all work similarly, so I'm just going to use the phrase Roth IRA. The money that gets in this account has already been taxed. It continues to grow tax deferred, and when you want to take it out, it comes out tax-free. The other good thing is the money you're storing here has no RMDs. You're not forced to pull the money out. You can take it when you need it and you want it. So in the future, if you want to remodel your kitchen, buy a motorhome, help a grandchild with college, do something fancy, remodel your house. You can pull the money out and pay no income taxes. So there you have it, folks. The three basic types of ways that you can store money and put them in accounts and how they're treated from a tax standpoint. Now, let me tell you about the Flintstones. Do you remember the Flintstones on TV? Well, the family looked like this. There was Fred, Wilma, Bam Bam, and Pebbles. By the way, I hope you like this slide. It cost me $39 on the internet to use it. And I'm going to go through an example of the Flintstones. So let's talk about the buckets. Here we have on the first slide, Fred and Wilma are alive. Now, Fred worked. He was the breadwinner. Wilma also worked, but she was the homemaker. She took care of the kids. And so all of the retirement money is illustrated in this bucket under Fred's IRA. And when he reaches 73, he's got to take out those distributions. Now, let's say that he went about investing the money and it was growing. He was taking out the distributions. And even though he lived to be age 85, the $1 million he had when he was in his 70s is still worth $1 million because the distributions were equivalent to the earnings. So when he dies, Wilma's going to go ahead and take over that IRA. The money comes over from Fred's IRA to Wilma's, no taxes, no penalties. She can invest it however she sees fit. And of course, when she's 73, she's got to take RMDs as well. Now, let's kill Wilma off in this story. Now, Wilma's passed away. She's still sitting on $1 million, and she's going to leave the money to the kids. So at Wilma's passing, Bam Bam and Pebbles get to decide what to do with the $1 million. They're going to split it 50-50, so they're each going to get $500K. Now, it's important that you know that Bam Bam and Pebbles don't have to make the same decision, but they have two basic choices. Choice number one is they can take a lump sum. In other words, Bam Bam could tell the custodian where Wilma's IRA was, hey, my mom died, here's her certified death certificate, here's my W-4P form, IRS form, and as a beneficiary, I'd like for you to give me a check. And they would write a check for $500,000. Or number two, he could elect to convert his portion of the IRA that Wilma has into an inherited IRA. And whatever he does isn't to have to be the same thing that Pebbles does. Now, let's say he closes it out. If he closes out the account and he gets a check, he's also going to get a 1099 in February of the next year. He's going to have to report $500,000 in income for that year because the IRA never had been taxed. This is not probably a very tax efficient way to manage your resources. Or he could do an inherited IRA, which just simply means he's going to have the custodian move the money into an inherited IRA. Once again, just like Wilma took over Fred's when he died, no taxes, no penalties. But of course, he is going to have to start to take RMDs. Now, the rules are different when it's an inherited IRA versus a spousal IRA. And under the Secure Act 2.0, he's going to have to start taking distributions beginning 1 year after mom's death. From years 1 through 9, he has to take the RMD. At the end of the 10th year, the account has to be liquidated in totality. So I did a little bit of research in advance of putting this presentation together because I wanted to show people how the options for inherited IRAs work. But I'm also going to show you later that a Roth IRA is clearly a much better legacy play than allowing your IRAs to be inherited at the discretion of your kids and then to take out distributions over years 1 through 9 and liquidate in year 10. And I found this on the internet. It was from the Vanguard Mutual Fund family. They have an outfit called the Enterprise Advice Methodology Team, and they did an analysis of over 1,500 combinations of how inherited IRAs could work moving forward. Here are some of the variables they put to create those combinations. They have different growth rates on the portfolio, 3%, 5, and 7. They had different account balances, 100, 315, 700, and a million. They did different inflation factors over the time period, 0.5%, 2.35, and 4.5. They took different taxable income levels for the beneficiary of the inherited IRA, 100K, 250, 370, 420, 600, 900, and a million. And then different income patterns. And they jumbled this all up in a software package to come up with what is generally the best way to take money out of an inherited IRA. And here's what they came up with. They did a case study of Henry and Willow Joyner, who inherited money from Willow's mother, who left them $1 million in her IRA. At the time they inherited the IRA for $1 million, they were already in a 32% tax bracket, making $420,000 a year. That's a lot of money, folks. Now, when they did this analysis, it was prior to the Secure Act 2.0 regulations. So they had a first choice of allowing the money to sit in it on a deferred basis for 10 years. The IRS has come back and said option number one is not available. But if option one was available, it would be the least desirable result because you'd pay $563,000 in taxes to do option number one. Option number two requires you to follow Secure Act number 2.0's rules, and that is you've got to start RMDs 1 year after the date of death and then liquidate the account in full in the 10th year. And under those 1,500 different combinations and variables, the taxes came out to be $532,000. But option number three was the best. What if you systematically took a somewhat even dollar amount based upon the performance of the portfolio, but over a 10-year window, you were taking big chunks of money versus small chunks of money, and of course, at the end of the 10th year was completely liquidated. And by doing equal distributions over time, you paid only $417,000 of taxes. So what I'm showing you here is option two versus option three saves the family $115,000 in taxes. And the key point here is that if you spread it out equally over the 10 years, the beneficiaries make out better than the IRS does. So folks, even if you never do a conversion to a Roth, just knowing this can save your family money. Now let's talk about the Roth. What if you carved out some of your IRA money while you're alive that you anticipated not needing to live off of? I.e., what if you did an IRA conversion on part of that $1 million? Here's the question. Would it save you on taxes and leave more money for your children, your grandchildren, family, and friends? And the answer is yes. By converting IRA money to a Roth IRA, it could be much better for wealth transfers. Let me show you what I did. I recently went to ChatGPT. Okay, ChatGPT is a software package on the internet for artificial intelligence. And I posed this question. And by the way, this was sent in the mail to all of my clients. So you're going to get this in the next couple of days. It was an insert in the newsletter. And I posed the title says here, who should get more, Uncle Sam or your kids? Let's ask ChatGPT, benefits of doing a Roth IRA conversion. Write a short piece on why it would be financially beneficial to do a Roth IRA conversion on some of your IRA that you intended to leave your children versus keeping it all in an IRA and having them do an inherited IRA when you pass, which is what we just talked about with Vanguard. Assume you're in a 22% federal bracket and expect the tax bracket to be 35% for your kids when you pass away 20 years in the future. Now, of course, no one knows if that will happen. Base the analysis on earnings of 6% all years, and the dollar amount will be $100,000 per year in conversions for a total of $500,000. Once again, we're converting only part of the portfolio versus never making the conversions to this IRA, and your kids do an inherited IRA under the structure, under the Secure Act 2.0. You can see in the three boxes below it, it's titled in blue. If tax rates go up to 35%, and we're comparing a Roth conversion, paying 22% now, in the far left box, your children would receive $1.6 million tax-free. To the middle box to the right, entitled Traditional IRA paying 35% later, your children receive a little bit above $1 million. And so the net tax savings is $561,000. Folks, this is just doing paperwork. This isn't trying to decide on an investment strategy. If you love your investment strategy, keep your investment strategy. This is just simply saying, how do I cut out Uncle Sam for a portion of the money that I've socked away for me and my family that I think I'll never need to live off of? And by the way, if it's in your Roth IRA, you can reach in and live off of it, right? Now, what if taxes stayed the same, 22%? Because of the way you have to take distributions in a Roth IRA versus a traditional inherited IRA at death, it still benefits the family even if taxes don't go up. It's a $350,000 swing in your favor to make the change even if the tax brackets stay the same. Is that impressive? I think so. So hopefully I've given you some reasons to seek further advice in this area. But what if tax rates were to go up to historical averages of 56%? Even if you were at the highest bracket and you had to pay 37% to make those conversions, it could substantially benefit you and your family. Folks, don't have a woulda, coulda, shoulda experience. Why don't you take action? I'm going to encourage you to do the following. Why don't you come see me? Don't let Uncle Sam kill your 401k and IRA. Did you know I have the software to help crunch your numbers so you can see if doing a Roth IRA conversion is financially beneficial for you? This is my offer. If you have $500,000 or more in qualified accounts, such as 401ks, 403bs, 457s, and IRAs, let me prepare a retirement tax savings analysis for you. If you will come see me before April 15th, I will waive the $699 fee in total and help you get the report in your hands to show you how much you and your family can save. That's my offer. What's your next step? Your next step could be call my office and book your free consultation. Number 2, go get your statements. Get your most recent statements for your IRAs and your 401ks. Gather them all up in advance of the meeting. And then get your tax return. It could be 2023 or 2024. It really doesn't matter. And come see me. So folks, pick up the phone, book an appointment, leave your checkbook at home, write down all your questions. Let me help you, okay? I'm here to help you guys save money on your taxes. I want to thank you for attending, okay? Don't keep this information to yourself. Share it with a friend. And remember, don't let Uncle Sam kill your 401k and your IRA. Thank you very much and have a great day.